Karibuni sana. So my name is Aurelia. I'll be moderating this session for today. It's a very timely session now that it's on Finance Act and the opportunities and threats it has in the pension industry. We'll begin with a word of prayer, and then now we can proceed to the business of the day.
Let us pray. Almighty God, we thank you for the gift of life. We thank you for the gift of this moment. And I pray that as we begin the meeting, we pray for your presence, we pray for your guidance, and everything you're going to discuss in the meeting, let it be for the betterment of the everyone present and for the betterment of the respective institutions. In Jesus' name I pray and I believe.
Amen. We have also been joined by Godwin Simba, the Executive Director of Finnet Trust and lead expert at Finnet Institute. So I'm going to welcome him to just run us through what Finnet does, and then we can proceed from there. So Godwin, if you're ready, over to you.
All right, so I think first is to welcome all our esteemed delegates or attendees to this webinar. We want to extend this warm welcome to all of us who have joined in for the discussions on the Finance Act of 2023. We appreciate the extent to which it has bestowed obligations to most of us as individuals and also as organizations. And I think it's coming in at a critical point where we need to have an understanding for us to make better informed decisions within our own organizations. We've been joined in by distinguished speakers from Ronald's, who are experts and they're auditors by their profession, and I guess we wouldn't have gotten a better pool of experts to dissect for us the aspects of the Finance Act. More so on the opportunities and the threats that it presents to businesses and also to individuals at large. As I welcome all of us to this webinar, allow me as well to just make a brief introduction about Finnet, especially for most of us who are new or we were engaging for the first time. Feel welcome, and for a high-level introduction, as Finnet, we are an independent financial network and trust company that offers governance consulting and training services by leveraging on expertise in pension and other financial solutions. And ideally, the host for this forum is Finnet Institute, which does trainings primarily to advance conversations in the financial services space, and also aspects of governance and leadership in the public and private institutions. So as any other business, we are guided by a strategic direction where we have our mission and our vision. But most importantly, we want to build a better tomorrow today by innovating and also combining the talent we have and also the experts that we have within the business to provide the best advice and future thinking in the world of financial services. And therefore, you find that we do have quite a lot of engagements and also infrastructure or technology that will help organizations scale. As well, if you have a chance to look at what we offer beyond the trainings, we are heavy in governance consulting and reviews, board evaluation. We also do quite a bit on strategic plans for both pension and also public and private institutions. We design policies and also organization management systems for organizations. We are also in technology space where we do solutions for institutions that help scale businesses, as well as also an employee benefits advisory. We do have an insurance agency or brokerage that helps to drive conversations on employee benefits and risk management for organizations. On the training arm, we have normally a training calendar that targets both the pension sector, governance for public institutions, state corporations, as well as also HR professionals and finance professionals at large. You may also have an opportunity to engage with us on issues of financial literacy and change management for your staff. This year alone, as Finnet, we've been able to engage close to 2,000 members on different programs, from close to 190, more than close to 200 institutions. We have both local and international trainings that we have earmarked for the different market segments we have. We have also partnered with the Institute of Certified Secretaries for purposes of advancing governance conversations. As you can note, we do both local and international programs, building capacity to different institutions on the different areas that I've mentioned. And our offices, we are located at Dafton Court, Riverside Drive, here in Westlands. The other bit is just to elaborate perhaps the clients we do have. I'm sure you can relate to some of those logos that perhaps would be some of the clients you've been engaging with. Among us, close to 200 clients we deal with in the business. So mine is just really to welcome all of us more sincerely, and also appreciate the opportunity to be with all of us for this webinar. I think with that, I want to hand over to Aurelia to moderate the session, and then we will be able to hear from yourselves in terms of any questions and answers towards the end of the session. Karibu sana, Aurelia, to proceed to the session. Thank you.
All right. Thank you so much, Godwin, for that. So he's just been able to mention but a few of the things that we do in Finnet. And in case you need any further information on that, please feel free to engage us through the website. All that is there. So without further ado, I'd now like to hand this over to Ronald, but I'm advised that there's a Peter Mwanja who's supposed to present first, and then Ronald will proceed. So for us to run smoothly, I propose after Peter Mwanja's presentation, we'll do the first round of questions, and then now we'll hand over to Ronald. I think that's fine. So Ronald, are you ready?
We're going to, so my name is CS Ronald Bwosi. I'm the group partner of Ronald's East Africa. At Ronald's East Africa, we do audit, tax, and advisory services to various clients. Patient industry is also a part of our industry focus. So for the patient industry, we do audit. We also do tax advisory. We do risk management. We do financial reporting, issues to do with IFRS 9 modeling. And also we do advisory in terms of just financial restructuring and governance issues. So it's a pleasure to partner with Finnet in order to do this important presentation and awareness on the highlights of the Finance Act 2023. With me online is Peter Mwanja, who is also who is a partner and head of tax and corporate finance for various industries. So we're going to do a co-presentation. There are areas that I will cover, and there are also the areas that he will cover. And one of the things I want to say about the Finance Act 2023, it's been one of the most disruptive Finance Act in the recent past, and really one of the most talked about Finance Act. In the previous past, not many people know about the Finance Act and all that goes with it, except for the tax experts. But today, even if you ask anybody on the streets about the Finance Act, it's no longer a reserve of the professionals and practitioners, but it's now a common word on the street about the Finance Act, and because of also some of the ramifications that come with this act. And we can say that this Finance Act has been introduced by the government in order to achieve certain objectives. One is the government wants to bring in reliance on technology, because, you know, globally, organizations are now adapting technology as a way of life, and everybody is talking about trying to adapt tech for the purpose of increasing the tax base. And I can say that because I practice both in Kenya, Uganda, and Rwanda, and Tanzania. Kenya, as a leader in the East African region based on the economy, we've not really been done very well in terms of automation of our tax system. I believe Uganda, they're done better with their IFRIS, which IFRIS has now is really ahead of time of the teams, because they have really implemented perfectly the IFRIS, and it's working so perfectly. So for us, we've become laggards in the region with regards to this automation. But I believe through this Finance Act is to fast track that digitization of the tax system, and we've seen various changes now to enforce this legal legislation that is anchored on technology. At the same time, we've been told about out of the majority voters, if you combine voters, you get something between 20 million people. Only 6 million people remit their returns. So again, through introduction of Finance Act each and every year, it's try to widen the tax base and get many people being taxed, seal loopholes, because we have people who always try to outsmart the tax system, try to bring in more legislation in order to curb tax evasion. We have tax evasion and tax avoidance. For your information, tax avoidance is legal. It's a way whereby you try to look at what are the loopholes in the tax legislation and try to exploit those in order to minimize your tax liabilities and increase compliance. And tax evasion is whereby you deliberately try to avoid tax. You actually decide to avoid tax. In Kenya, I can tell you, most of us, SMEs and businesses, we are tax evaders rather than tax avoiders, meaning we explicitly just refuse to pay taxes. And that is what is called tax evasion. So the essence of any tax law is to try to mitigate on the risks of tax evasion and make sure that everybody is compliant. So please, as you have arranged this webinar, please note the two words: tax evasion is illegal. If you are caught, you'll be punished through tax penalties, interest, and the same time imprisonment. Tax avoidance is legal. It's a way of trying to look at the loopholes within the tax system and try to see how do you mitigate the tax liabilities so that you are not a fool and the one paying everything to the government, even whereby tax is not due. So the essence of this Finance Act is to try to reduce both so that people have very little options not to pay taxes, either through tax avoidance or through tax evasion. So widen the tax base for individuals and businesses, increase the tax rates. Again, this Finance Act has come in to increase the tax rate and cause pain to Kenyans. Again, that is the biggest problem also with it. You heard the president talking about we need to benchmark with countries like France, whereby they pay a significant portion of the GDP is paid to taxes, countries like South Africa and all that. Whether he's right or wrong, that is only a matter of time. But again, you can really read from his speech that indeed this Tax Finance Act was immense to increase the rates and actually get more revenue for the government. Harmonize our tax laws with the best practices in the tax administration. Again, any country does not operate in isolation. We have a global trends with regards to taxation. We talk about the OECD, the Organization of Economic Cooperation Development Countries. We have now the G7. We have global trends in the taxation. All of us have been witness the issue of digital service tax coming into play and really disrupting the tax collection system. So Kenya is not in isolation. Best that the business has the world has become a global village. It is also in the best interest of our country to benchmark with the global trends with regards to tax policy and tax administration. And then the other issue that we can say about this Finance Act is also accommodate international collaborations in our tax laws. Again, you realize that there is a lot of trade deals being signed by different countries. Just recently, we had Iran in the country. We have people from all over the world. We are signing with the trading pacts. We have double taxation treaty agreements that are emerging. The conversations in terms of how do we collaborate in business and try to look at what tax hindrances might be there, so that by making various tax amendments, we're able to engage these with the international community. And of course, one of the things also that we have seen, introduce tax amnesty. The role of tax from a strategic perspective is to try to spur economic growth, encourage or incentivize industries that the country is prioritizing, at the same time discourage bad industries, bad habits and all that. And of course, take advantage of also booming industries and all that. So you'll see that most oftenly, if you are in the alcohol business, if you are in the cigar, you normally call it sin tax. If you're doing things that are affecting health, if you're in industry that is affecting deforestation and all that, because globally now we're talking about the climate change and all that. So if you have in those industries that are considered hazardous, you are likely to see significant tax increases, including betting and gambling and all that. They are a hazardous industry, we call them sin taxes, to discourage certain behavior. So you realize that tax has some behavioral shift element that comes with it. Recently I was in Las Vegas, and the betting business and gambling is booming. But in spite of increased taxes, every year they're increasing taxes to take advantage of that. And I realize even cannabis is also legal, but at the same time, there is also tax implication for that when you are doing cannabis. In fact, when I took one of the taxis, I was offered cannabis. Because by taking it, you're also contributing to tax. But I can guarantee you, I never ever tested it. So it is just to show that those bad industries are being discouraged through tax legislation. So with regards to the journey that we've had, it's been a really, really a long journey. Of course, the process of tax laws making and the finance bill is introduced to the National Assembly on 28th of April. And then now on 4th of May, you realize that there is the first reading of the finance bill in Parliament. And then on 20th of May, there is public participation. People give views and all that. And we all came in big numbers, including us here, to tell the government, hey, you're going to finish us, all that public participation. Whether that has an impact or not, again, it's a question for us to say, but the law requires that there must be public participation to get public input into the in the tax law making process. And then there's a second reading in the bill in 14th of June. And then on 20th of June, third reading of the bill. And then now people voting on it, and you can realize there was a war between the Azimio side and the government side, Kenya Kwanza government, and the wars and all that. And again, whether these people vote based on the citizen interest is a question for another day. But I can tell you, the parliamentarians made a vote of it, became an act, 26th of June. The president ascended to it because the president is the government, and the government are the originators of this important piece of the legislation, and he signed on it after it has been deliberated by the parliamentarians. And because we are in a democratic country, there is the legislature, there is the executive, which is the president, and the judiciary. So for you to have a very successful lawmaking process, the three parties, the executive, the judiciary, and the legislature, have a say in that. So you realize that when it was taken to the court suspended it. The same Finance Act is suspended by the High Court, and extended conservatory orders prohibiting the implementation of this act. You remember the Okia Omtata-led team, who did a very commendable job in trying to protect the citizen and all that. So then on 28th of April, the Finance Act was also, now on 29th of July, you remember the Court of Appeal lifted those conservatories and say that the executive did not act in actually bringing this piece of legislation, and they followed the due process, and they didn't find anything that was injurious to the citizens in that particular piece of legislation. So this is the journey that we have all witnessed, and it's good to master that process and have just into perspective those procedures that what has really ensued. So what is in this Finance Act? Maybe, okay, just to complete on my remarks, and I say that I know people have complained, we have gone on the streets, people have died because of this Finance Act. And what I can say that the essence of this, and thank you so much, Gordon Simba, for making this meeting, because what I realized that as Kenya, we really, really a majority of us are very ignorant of the tax laws, and sometimes we go up in arms in the streets without perfect knowledge. That is the biggest tragedy we have as a country, because most people don't have a deep understanding. And whatever you will see people on the streets, people dying and demos and all that, not a bad thing. I'm not against all that. I'm not a politician as a matter of fact, but I'm just saying that the biggest problem is the information gap. Do people really understand what is actually in this Finance Act? So the essence of this this webinar is to help you actually no longer be a lay person, interact with this government and the Finance Act from a knowledge perspective rather than from a theoretical perspective, and try to see how do you debate like a scholar or like a knowledgeable person. Except for the two things that were in this Finance Act. One of them is the fuel, 8% increase on fuel. And remember, our fuel was being taxed at VAT rate of 8%. It was increased to 16%. That has had significant impact on the fuel prices of the country, because now a liter of petrol is almost 200 shillings. That was quite a devastating change that has come, and was implemented even before the Court of Appeal pronounced itself on this act. That had very far-reaching consequences. And also the other issue is the introduction of the 1.5% housing levy. Those two things, I found them to be one of the few things that were very harmful and had a direct impact to our economy. But when I look at the majority of the Finance Act, as an expert, I think this Finance Act has also had some very good, because it has made some things very explicit. It has also, there were in the previous tax laws, there were a bit of some confusion, especially when it regards exported services, when it comes to taxation of chamas. It was really, really misleading and all that. But this Finance Act has pronounced itself very explicitly to lower the burden. So it is not that 100% of this Finance Act was bad, except for those two things: fuel, 8% to 16%, and housing levy of 1.5%, which we will look at it now. The majority of it had some very positives, which sometimes, less we look at it professionally, we might actually throw away the baby with the, I know, isn't it? With some good things in it. So it's good always just to have a deeper perspective. Anyway, let's go deeper in it, because before I will invite also Peter in the middle to comment on some things. Peter, I hope you're still there. Yeah. I hope
yes, I'm still here.
Yes, you're still there. Yeah, so I will invite you in the midway to comment on some things. One of the most disruptive way on this finance bill is the pay rates. You've seen that the finance bill has, of course, nothing 10% between first to 8,000, 10%, 100,000 and 25%. This is the graduated rates. That is annual. If you take your salary times 12, those are annual rates, and then 30% on 5,600 and 12,000, and then on the next 3,600, 3,600,000, that 2.5%, and then on the rest, that 5%. So these are for the high income earners. This is the people who earn more than 500,000 shillings per month. So 500,000 shillings to 800,000 per month, having a rate of 32.5%, and then those people more than 800,000 are getting a rate of 35%. So please take note of that. These pay rates were supposed to be 1st July 2023. Again, a very important clarification I would want to make before I proceed is that when we are talking about those rates, we are saying that the effective date is 1st July 2023. You remember that this Finance Act has been now allowed by the Court of Appeal 29th of July, and the government is very aggressive and is saying that, hey, you have to backdate your tax computation. So the salaries for July, you have to reopen them and compute the tax. So I don't know the implementation, how it's going to be done. If the government was gracious, it will say, let's make it from 1st of August. But they're like, we want the taxes from 1st of July. I believe it's bad PR but we hope that they will get some sense and say, let's make it from 1st of July, 1st of August, because immediately a legislation is suspended, it means it has to wait. You cannot now punish the citizen for the period that has passed, because it wasn't law. It is now law from 1st of August. If we make it that's okay. But saying that now we have to go and backdate our payroll and pay 1st of July 2023, and then it's going to have an impact. But please don't follow my word. Currently, the law is 1st July 2023 for pay. You have to go backdate to compute using those rates. For people earning more than 500,000, tax them at 2.5%. For people earning more than 800,000, tax them at 5.5%, until as and when the government decide and say, well, let's do away with that and just tax you from 1st of August. Again, I believe that's a very bad PR. So revise your pay accordingly. And that is something that we can collaborate beyond this seminar, this webinar, and help you to restructure your payroll so that you can be able to be compliant. The other issue is what we're talking about, the National Housing Development Levy. The Finance Act introduced this levy, 1.5% of the employee's gross salary payable by the employer and the employee. Again, you can notice 1.5% of the employee's gross salary. That is a bad thing. If it was on basic pay, it could have been be fair a bit, but saying about gross pay, and my colleague is telling me here that we need to look at the conflicting part of the labor laws and the Finance Act. They will be conflicting because you're not supposed to impose some of these levies on the gross salaries, but on the basic salary. But the Finance Act is saying we want 1.5% on the gross. And let me tell you something about this housing levy that I don't like personally. Initially, we were talking about 3%, and we are saying that we needed 3% of 3% from the employer and 3% from the employee. And the finance bill was going, because the finance bill, before coming to Finance Act, it was recommending 3% from the employer, 3% of the employee, capped at 5,000 shillings per month. So it will be, if you're earning 100,000 shillings, it will be 3%, which is 3,000 shillings. And then 3% from the employer, 3,000, which is 6,000 shillings. But then you will only pay 5,000 shillings. Now, when it came to the 1.5% Finance Act, what they say after discussion in Parliament of our public participation, the government decided to beat citizens at their own game. They say, you want 1.5%? Yes, 1.5%. But in this Finance Act, there is no capping to it, which is a tragedy, a disaster, because it means if it's 1.5%, if you're earning $1 million, it will be 1.5%, 15,000 shillings, 1.5 15,000 shillings, that is 30,000, which is quite devastating to somebody who is earning more than, because there is no capping at it at all. Something again, we need to go to the streets for, assuming that some decisions can be made on the streets. I don't know, but I can tell you that is where the rubber meets the road. 1.5% of 1,015,000, 1.5%, that it's quite devastating. It was better when it was 3% because the cap was 5,000 shillings. It's going to see so many people increase their payments to KRA and all that. So it has far-reaching impacts on the taxation. The other issue is the Act imposes 2% penalty on the unpaid funds on employers who fail to deduct and remit the said levy to the commissioner, which again, which is also a problem. The commissioner KRA has been appointed as a tax agent, and the government wants this money now from 1st July. Even though the law has come into effect on 29 July, when the government, the High Court, the Court of Appeal lifted the conservatory orders, the government wants the money from 1st July. So me and you, we need to put our house in order. It's crazy. So the other issue that is also very good in this government, in this Finance Act, was the mileage allowance, which were made tax-free. Initially, this place was a very gray area. Yes, we used to argue with the KRA that this person is using his car for business and all that. And during the presentations, it will be really a tall order to convince the KRA what people are doing and all that. But the government has come and said that if you are having mileage allowance, are tax-free. So meaning that if you are claiming, especially for the pension guys, you normally get those allowances for mileage, especially board members, staffs, and all that. So what the government is saying that if your mileage is within the AA rates, then the Automobile Association of Kenya, then it is allowable expense to the organization, and also to you, it is a tax-free allowance, so it will not be taxable. But initially, it was a gray area. There will always be your word against KRA words, which is a good thing to try to make it more explicit. Another area also, I don't know how it affects pension schemes, but I will guess that probably the CEOs of pension schemes will be paid for a number of club fees at Mudaiga, at Currents Sports Club, at Parklands, at whatever golf clubs and capital clubs. Some of these subscriptions have become so huge. The government now is saying if your organization, your pension schemes pay for you those entrance and subscription fees, and then now it will be subjected to tax. You will be taxed. So the government is saying that is a much more a benefit than advertising. I know some of people are paid for so that they can do networking, they can get business for their organizations, but the government is seeing for it is just a benefit because those clubs now are being considered entertainment rather than marketing. Again, what a perspective to consider it. Yeah, but I know some CEOs of various organizations and pension schemes whereby the government, when you go to these clubs, you pay one-off entrance fees, which is always very significant. And most of the clubs I know, it's more than 500. Others have gone to 700, 1 million more if you're in those premium clubs. And sometimes that is a very long-term membership. And sometimes you leave the organization that paid for you. Probably that is the reason. But to treat this club and entrance and subscription fees as benefits rather than as part of the corporate expense. So as I take a bit of water, so maybe Peter, you can explain that on shares issued in lieu of cash emoluments by startups. Peter, are you there? Okay, assuming Peter might have some challenge, maybe as he puts on his mic. So the Finance Act defers the tax point on benefits from shares from eligible startups to its employees. I don't know how it will apply to you guys here because you are in the pension industry. So initially, there's something which you normally call the ESOPs, employee share ownership scheme, or employee share ownership plans. So you realize that in this country those things are a bit not very strategic. But I've seen big companies like Equity Bank saying that now going to actually offload some shares to employees, and then now those employees have a benefit besides cash, because when you're starting a company, maybe you might not have enough salaries to pay them and all that. So the only way to motivate them is also give them equity. So what we're saying that the Finance Act defers the tax point. Tax point is when those benefits are taxable, because when you get free shares, those are benefits to you. So it means they are taxable. So the Finance Act defers the tax point on benefits from shares from eligible startups to its employees in lieu of cash emoluments to within 30 days of the earlier of the expiry of 5 years from the year that the shares were awarded. So you will not pay tax until 5 years from the date when those shares were awarded. And 2, you will also pay tax the disposal. If you sell those shares within 5 years, after 1 year, you will be taxed for those shares that you've been given as a benefit, meaning that if you're given shares worth 1,000,000 shillings, that becomes a benefit to you, and free shares, then that benefit is added to your salary and you are taxed on it. So the law says that you will not be taxed only as if you've stayed with those shares for 5 years, or 2, or if you sell those shares and the employee ceases to be an employee. Again, if you leave that organization, that is also becomes the tax point. You will pay for those shares. But again, this finance bill is limiting those benefits, those non-taxable benefits, to eligible startup means to the ones that have a less than 100 million. So if an organization has a turnover of more than 100 million, like Equity Bank, this will not apply, because I saw Equity Bank, they're giving free shares. That's why I'm using it. They're giving a share bonuses. If you have a turnover less than 100 million, that's when you can benefit from this. And then if you don't carry out management or professional training activities, again, like Finnet, if you give your people these ones, you are not eligible for non-taxable shares, and then not formed as a result of restructuring, splitting on an existing entity, or has existed for less than 5 years. Again, this is to allow entities to try to. I've heard the Safaricom has gotten a nod to invest in startups and all that. Again, this is actually supposed to benefit employees of those startups, so that they're able to benefit from the offloading of shares of those companies, and just to allow the startups and make them more viable. What you realize that most of the startups in the country, they don't go so far, because one, when you're starting a business, you'll agree with me, to attract employees is very difficult, and two, to compensate them, and then three, the other business climate and the implications and all that. So you realize that our startups don't go so far as compared to other countries, or even if they go far, because of not be able to afford those things, they are bought up by other companies from other countries. So this law is trying to encourage the speed of startups, to try to encourage the startups to actually reward their employees and all that. The other issue that has also been brought up in this Finance Act, which also I don't know might apply to you, is the issue of post-retirement medical fund, which are saying that resident individuals who make contributions regard to post-retirement medical contributions will now qualify for post-medical retirement medical relief, equivalent of 15% of their contributions, or 60,000 per annum, whichever is lower. I've seen DevCo, that's Defense Forces, they have their own medical scheme, which benefits those employees who retire. So if you are serving in the forces and you retire, and sometimes when you are retiring above 60 years, 70 years, those are areas that those are very evil days. You are likely to incur a lot of medical costs when you are those sunset days, or when those post-retirement, and that is why you might take care of your pension, but then now medical may just erode all your pension because of the huge bills that you incur, because post-retirement healthcare becomes very, very important. And you've realized that most of our insurance companies, they have not been really taking into consideration people who are who are retired, 60 years, 70 years, 80 years. It's very difficult to get a policy from our insurance companies. If you do, the premiums will be crazy. So there is this then a culture or habit or strategy whereby you engage in actually trying to contribute to a post-retirement medical contribution, so that when you retire, you don't suffer a crisis with regards to medical cost. The government is encouraging that by giving you a relief. So they're saying that when you're contributing to a medical plan whereby it will benefit you post-retirement, then those contributions, you get a relief of 15% of their contributions, or 60,000 per annum, whichever is lower. So you are able to reduce your payee if you're contributing such a scheme at 15% of the premium, or 60,000 per annum, whichever is lower, which is 5,000 shillings per month. So assuming that you are contributing to a post-retirement medical scheme of something like around 10,000 shillings per month. So from your pay, you do 1,500 shillings. You remove from it, and that goes reduces your pay by that amount. If you're contributing 100,000 shillings per month, then it is 15% of 100,000 shillings, which is your contribution to a post-retirement benefit scheme, or 5,000, whichever is lower. So KRA is very selfish. They will only allow 5,000 shillings if you're contributing 100,000 shillings per month. Exemption investment income for, so normally some of these post-retirement medical schemes, they always are invested. so that that money keeps on accruing income and all that. And I've seen a good example of the defense forces, the ones for KDF, who have come up with their post-retirement medical scheme, and they invest that money. So what the government is saying, that all income accruing from that fund, then it is non-taxable. And most probably, as an advisory to a pensions industry, you, besides pension, which is money that benefits you from when you retire, the pension industries could choose to restructure their business, whereby a portion of that money is not pension, a portion of it probably becomes a medical fund contribution, which serves these people in case they have a problem. Then now they benefit from those taxes that are there. Another thing to look at in this Finance Act is the various corporate income tax changes. What corporate tax changes are there in this finance bill? One of it, we have seen the ITIMS compliance, non-allowable deductions. The Finance Act has disallowed all expenditures that are not supported by ITIMS invoices. This shall not apply to imports, emoluments, interest, investment allowance, airlines, passengers, tickets. This is an enhancement measure of business whose invoices are not compliant with the rollout ITIMS. Again, a very, very devastating, or something that has a very far-reaching implications when it comes to compliance with the ITIMS. So, they're saying that if you have a supplier who is not ITIMS compliant, then those expenses are not supported. I know from the pension industry, you guys have real estate, you have commercial buildings, which you charge VAT to your tenants, and this money is used also to enhance contributions to pensioners and all that. So they're saying that if you're charging VAT on those rental income that you're charging to your customers, if those customers are not, and then if you have suppliers who are supplying you various things, and those suppliers are not registered for, or you have that business income that you're getting from those income earning properties, you cannot offset the expenses that are from suppliers who are not ITIMS registered. So it's a big issue, because initially it was you cannot claim VAT from a person who is not ETR registered, but then I'm saying that now you cannot claim expenses that are not ITIMS registered. Again, that is going to have far-reaching implications on organizations. But we are saying that it will not apply to imports, because originally, if you're getting supplies from abroad, you don't expect somebody in China to be registered on ITIMS. So they're saying those ones will be allowed. Emoluments, those are salaries. Interest, those ones are also not allowed. Investment allowance, also these are things like depreciation and all that. Those are expenses allowable. Airline passenger tickets, they're saying those ones will not be allowed. So this is an enhancement measure of whose means are not compliant. So this is actually the way I said initially, that the essence of the Finance Act was also to accelerate automation, to accelerate digital transformation. And to do that is to force everybody to be digitally fit. So this digitization is whether you like it or not, because now there is no room for analog business. So you're being forced that your business must be digitally registered for trading. Otherwise, if you're not, then you really blocked out from business. So again, we have had, I don't know, Peter, are you there? Peter?
Yes, Ronald, I'm here.
You can comment that on interest deduction restriction.
Right, so thank you. So I hope you can hear me.
Yes.
My name is Peter Mwanja, tax partner at Ronald LLP, and I'm introducing myself because I know some of us have joined during the course of the session. So on the issue of interest deduction, as Ronald had said, it's a restriction that is applicable where we have a non-resident company that has borrowed, or rather a company that has non-resident shareholders that has really borrowed so much externally. And in that case, then there's a restriction on the amount of interest that can be expensed. Initially, when this law was legislated in 2021, it seemed to almost apply to all companies. That is both local companies and non-resident companies. But now this particular provision is bringing clarity and saying this will only apply to non-resident persons. So it's sort of a clarification in the sense that it's not a restriction that will be applicable to everyone, but only to companies that are non-resident or that are paying loans to non-resident person. And the same applies to the foreign exchange laws. So using the same provisions or using the same line of thinking, even the foreign exchange losses will be treated the same. So I hope that clarification is clear.
Thank you, Peter. Maybe you can go ahead and also explain the repatriation of income also.
Yeah, so on this part, and I know this one is not really applicable mostly to pensions. Again, it's a clarification in law, or rather an introduction of a new tax specifically to non-resident companies. And what the Finance Act is telling us is that those non-resident companies, when they repatriate the income or the profit that they're making from the country, then there will be an additional tax, an additional 15% that will be chargeable on that income. So this is sort of an initiative to try and encourage companies or non-resident companies to use or to utilize all their profits and their incomes within the country, of course, for purposes of job creation and further investment in the country, and try to discourage them from taking the money to their home countries, because you'll all agree with me, when money leaves the economy and goes back to, let's say, China, goes back to the US, it will only benefit people in those particular countries. So to try and discourage that, the government has introduced this particular tax, which is, or rather, which will be applicable to non-residents at the rate of 15%. So the most important thing is to notice that this is on top of the corporate income tax that they already pay. So if, for instance, they pay the 30% tax, then any additional amount that they decide to send back to their home countries, they will have to pay the additional 15%. So this will essentially mean that non-resident companies will be taxable almost at the rate of 5%, which is simply 30%, which is applicable to everyone else, and a 15% for the income they decide to repatriate or to take back to their home countries. Yeah, so that is how this particular provision will apply. And it could be argued that it will be a bit unfair because investors from all over the world, they want to put their investment in particular countries with the hope that they can pay taxes there and repatriate the rest of the income to their home countries. So it might be looked at it as a way to discourage investors, because there are people who would prefer to go to, let's say, Uganda. They make their profit, pay their corporate tax in those home countries, and then whatever remains, they can do with it however they want. So it might make the country a bit uncompetitive, especially compared to the region, because most of our neighbors don't have such provisions. So it's something that might not really achieve the intended purpose of revenue collection, because if the investors decide to work with different countries, then we are going to be the net losers as a country. Yeah.
Thank you, Peter. I'll be calling you again to explain the digital tax. As also, you just stay put because we're going to do this presentation collaboratively. So something else I just want to talk about, thank you so much for clarifying on that. Something also I want to talk about is the issue of turnover tax. And I know sometimes you're saying that, I'm just working in the pension industry. How does some of all these tax applications work? And I'm always saying that everybody in this country has an idea. And at least if you take 2,500 people, all of them have business ideas in any sample of 2,500 people. And 10% of these people have some businesses, side hustles. And you might be having your side hustles there, either doing cleaning or you're doing some small business you're running on the side. Of course, out of these 250 companies, which is 10% of the 2,500 people who have business ideas, at least 50 of them now will always now transition from the employment of from these ideas also into full-time business. And maybe 50% of them, this is 25, will become corporates. So that's why 1% of the people are in the business industry. So 25 out of 2,500 is 1%. So again, it's for the purpose of you knowing that this, whatever business you are in, whatever industry, wherever you are, you'll be affected by this tax in one way or another. So if you have your side hustle, your company that you are running, and your turnover is less than 25 million shillings, and then you will be taxed at 3%. You can decide to do 3%. But normally this provision, since it was introduced in the law, has one of the biggest misconceptions, because people in the management consulting, they want to use this one, but there have been explicit exceptions that if you're in management consulting, if you're in the training industry, in the professional world, you can't apply the turnover tax. But the turnover tax actually is into effect to help the informal sector to comply. So businesses that are in the informal sector, rental income, interest income, management consulting, training like what Finnet Institute do, will not always will not be qualified to apply this. Because, when you pay the turnover tax, you actually are not supposed to pay the VAT and all other taxes. It's a simple form of tax to help the informal sector to comply, to simplify the tax regime for the informal sector. Initially, the Uhuru government had put it at 50 million shillings, 1%, which was quite interesting, 1% at 50 million shillings. But this government is saying, hey, wait a minute, we need to increase the tax base. So we're saying 3% of 25 million shillings. If your turnover is between 1 million and 25 million, so you pay 3% and you've covered yourself for all forms of taxes, which is still interesting, but again, and a lot of assumptions being made there with regards to this turnover tax. So those are some of the worst things coming in. And imagine it's coming in from 1st July 2023. So if you are running that barber shop, if you're running some Juakali sector, you're selling spare parts, you are doing some business that is not in the formal sector or like the consulting and all that in the professional world, and then you can be able to apply that 3% turnover tax from 1st of July if your turnover is not more than 25 million shillings. And the other issue that is also coming up from this Finance Act is the issue you're talking about monthly rental income. And monthly income.
Just to interject, I'm thinking before we proceed to the monthly rental income, can we have the first round of questions?
What you can do, really, we can finish with the corporate tax and then we get questions before we go to the VAT, I think so. We go before we go to VAT, because this is all corporate tax, and I hope somebody will ask questions on VAT. So please, if you can just write, sorry for that, but please write those questions. When we finish shortly, then we take the first questions of the first round of questions. The other issue that comes in is monthly rental income. And we're saying that this is a good thing. And I know most of pension schemes have rental property. And if there is no pension schemes, probably you as an individual, you have rental property. So we are saying that initially rental property, you had what you call MRI, the monthly rental income. If you are making a rental income of 15 million shillings and below from your rental property, then you are supposed to pay. Initially, we've been paying 10% of that you pay to KRA every 20th of the following month. But KRA is now saying you can only pay that, you can now pay 7.5%, which is a good thing. But again, it's a tragedy in the tax, because people who own properties are highly capital invested. But then now they are being given a very good tax regime, 7.5%. But again, something to note, by the way, which again, there's a lot of confusion. This monthly rental applies to only residential rental. If you are in commercial property, irrespective of your turnover, if your property is commercial, then this does not apply. You will actually tax it just like any other business income, which is you take your income, assuming you have an income of 10 million shillings, commercial, your expenses are 5 million shillings. The remaining 5 million shillings is taxable at 30%. But this 7.5%, which is a turnover tax on the residential rental income, up to a maximum of 15 million, something that we need to make. One of the most also not interesting thing on this tax is capping that to, you have to pay that within, is saying that you can, the commissioner is empowered to appoint a person who receives rental on your behalf to deduct that money and remit the deducted income to the commissioner within 5 days. It's crazy. All of us are going to be running up and down to go and comply because the money, the government doesn't want any credit terms on its taxes. So they want it within 5 days. A good deal, but the period crazy, you know, all of us. Effective 1st January 2024, at least we'll cross that bridge when we get there. Peter, about digital service asset tax.
Thank you, Ronald. Quite a bit interesting part there on the monthly rental income tax, and I think there has been a wide discussion how it's quite an irony that a government that came into power on the basis of empowering the small businesses, the mama mboga, is sort of giving tax reductions to the capital, the heavily capital invested people, and of course increasing taxes for the small businesses. Now let's look at the issue of digital asset tax, and one of the things that that we need to note regarding a Finance Act is that it's sometimes meant to align the government's laws with the dynamic changes in an economy. And we've been living in a world that is going through a digital transformation in terms of how we do business, in terms of how payments are processed, in terms of even how wealth is kept, in terms of assets and the like. And it's always important for the government to also update its laws so that there is no gap in terms of, that we have certain changes in the economy, but our tax laws or any other law have not been updated. So with respect to digital asset tax, it's sort of an introduction. It's a new tax that has been brought about to take sort of advantage on the changes that are taking place from a digital perspective. We've seen a lot of digital transformations and a lot of digital disruptions that have been taking place. For instance, people are now trading using Bitcoins, others with Litecoins. And I know in the last couple of days, we have also had a lot of conversation regarding the WorldCoin, whereby a lot of Kenyans stand up to register for the WorldCoin. So it's sort of a way to try and tap into that market. And what they're saying is that if you transfer a digital asset, then a transfer or a tax at the rate of 3% will be applicable on that particular asset. And they've gone ahead to define these digital assets to be anything of value that is in the form of cryptocurrencies, a token code, an NFT, or any other token of a similar nature. So when that is transferred, then a 3% tax will be applicable, and this will be payable by the transfer or the person who owns the platform for transferring that asset. So it's important to see that we as the world changes, as the economy also takes changes, then the government also tries to keep up with those changes and ensure that it is tapping or it's able to generate revenue from all those changes. So that is all about the digital asset. And of course, we can see the sense. We would have thought this is a foreign subject, but now with the WorldCoin, the discussion surrounding the WorldCoin, and people going to scan their eyes for the same, it sort of shows why some of these changes could be very critical. So I think, Ronald, you can proceed to the next presentation. Ronald, if you can hear me.
I will also, thank you so much, Peter. You'll also come in to wrap up on transfer pricing and then we go to questions. But also just before you do that, I would wish to talk a bit about that. Sorry, I'm wondering why my PowerPoint is not moving. So we'll come and talk about briefly about the rental tax. The biggest problem we have in this country, just before you thought of 7.5%, is very interesting. Again, just trying to highlight a bit on the rental. You will notice that it is on in the rental, mostly commercial, you can be able to deduct your capital input. But when it comes to residential, you cannot deduct your capital input. So most oftenly, the capital input in issues like, for instance, when you build a property for rent and you want to rent it for offices, assuming that the property took you like 100 million shillings. Actually, what the law says, you can claim that construction as what you normally call commercial building deductions. So the tragedy is if you actually construct a property for residential, you cannot claim any capital deductions before you start paying taxes. And I believe it is in that spirit that this government, so let's reduce our monthly rental from such property to 7.55%. The only challenge is that now if you're earning rent more than 15 million shillings, then it is going to be a bad thing. If I was the government and I wanted to encourage low-cost housing, I would say that now, if you construct low-cost housing, you can claim your capital input, all of it before you start paying taxes. So again, that is something that you need to really take note of it by understanding the implications of some of these laws. Yeah. So the other issue is what you call the qualifying intellectual property income. And what you're saying that the introduction of preferential tax rate applicable on qualifying intellectual property income. So this intends to position Kenya as a research hub that will attract much investment in research and development. So the thing is, need to define qualifying intellectual property and then the preferential tax rate applicable. Such expenses who have incurred research and development expenditure of this intellectual property shall benefit from preferential tax rate. Again, this has not been, we have not gotten the preferential tax rate for intellectual property income. So intellectual property is, for instance, if you discover actually I'm told that Kenya discovered initially, the medicine for HIV and AIDS, and you have intellectual property over that medicine. Therefore, as a owner of those intellectual property, then you get rental income. But you realize that most of us, we have ceded our intellectual property to foreign countries because of selling of that intellectual property, ceding it to multinationals who now leverage on that and develop bigger and bigger. So as a country, we are saying that any income, it's going to be given some preferential tax rates to allow Kenyans to innovate and come up with the brilliant business ideas that will take us to the next level. So up to that point, I realized that it will be far much gone before we finish this. I will want to allow you to take some few questions as we take some water, and then now from there we come and wrap up this important subject of the Finance Bill 2023. So we can have some very burning questions. We take them, and then now we proceed with our discussions. I don't know whether that is okay, Aurelia.
Yeah, that's perfect. So
Yeah.
thank you so much, Ronald, for that presentation. It's very insightful. Quite interesting conversations we're having around this financial act and taxes involved. So I'll just start with the questions that I can see on my chat box. And then for
Yes.
other pressing questions, please just raise your hands so that we can now address them. So let me start with the first one. There was a question from Mogere. So he was asking, regarding the house levy, will the cash be deemed as allowable deduction like NHIF and NSSF? So have you noted that down, Ronald? Do I repeat the question? Okay, I think your microphone is off.
Proceed with the question.
All right. Okay, that's fine. So there's another one for David Chesire. Oh, okay.
Repeat the first one, Aurelia.
So Mogere was asking, in regards to the housing levy, will the cash be deemed as allowable deduction like NHIF and NSSF?
Okay.
There's that one.
Mhm.
There's another one from, just a minute. I think I thought I saw another one, but you can answer that as I try get others from the team.
Whether the housing levy will be an allowable deduction. We expect that to be happening, just like NSSF and NHIF. I don't know whether we've gotten detailed guidelines of that. Peter, you can comment on that? It will be an allowable deduction. So normally, for most levies like NSSF and all that, that will be an allowable. NHIF is not an, of course, even NHIF, they say they're going to do like 15% of it. So we expect that the housing levy will be an allowable deduction, especially as KRA comes up with now finds up the rules to firm up that. The only challenge that we have, that housing levy, it is still so material a levy, because as I said, that when you have an income of about 1 million shillings and you do like 1.5%, that's 15,000 shillings, and your employer is doing 1.5, that's another 15 million shillings. It's quite significant. We hope that that housing levy area will be a bit refined. One, to make it a bit to say 1.5%, 1.5%, and limit it to an amount of about 5,000, the way it was in the finance bill, so that we don't really suffer a lot. But at the same time, that we expect that when KRA as it's making those rules and guidelines, it will also make it it becomes also an allowable expense. Yeah. So that is the response to that.
All right. Thank you. I hope Mogere Ronald has been able to answer your question properly. So there's another one from David Chesire. Is
Yeah.
asking, what are the taxes for club membership or subscription? There's that. And there's Stanley Chepto. What will happen if I have committed to third of my pay slip on the 1.5% on housing?
Okay. So if I'm not able to see those questions, they are on the chat or the questions.
Yeah, they're on the chat box. So I think I can just read them out to you, all of them, so that you can answer them at once.
Okay.
Or what
Yeah,
do
yeah.
you think?
Yes,
All right.
yes.
So,
It's okay.
One from Kevin. Are people earning less than 24,000 chargeable to the housing levy?
Hmm?
There's another from Anthony Kimoi.
Hmm?
What happens to secondary income? The rate has been 30%. Does it mean now it will be taxed at 35% max band?
Mm-hmm.
Another one from Margaret. There doesn't seem to be a cap on the amount for the housing levy.
Mm-hmm.
Just say 1.5% of gross salary. I think
Yeah.
she was commenting on one of the questions.
Yeah. Yeah.
All right, you can proceed now.
Yeah, so currently as it sits, because people below 25,000 shillings, they're also paying NHIF and NSSF, it is implied that they will also pay a housing levy, irrespective, even if they are not within the pay bracket. You realize that there's very little relationship between pay and housing levy. The government expects that everybody will pay housing levy irrespective of their income levels. That is another worst thing about this housing levy. And then the other issues, yes, I agree, 35% will be the maximum tax band, and it will apply for people earning more than 800,000. So the KRA has expanded the tax band. So people earning between 500 and 800,000, after you've exhausted the 30% within that, you go to 32.5%. Then over 800,000, any earnings above that, you are taxed at 35%. So it becomes the maximum tax band. So need to do some very rigorous tax planning just to ensure that you minimize your pay there. Yeah. Is there any other question?
Not at the moment. If somebody has a pressing question, please raise your hand or utilize the chat box. But I can see Erin Karaoke has just attached a part of the, I think, the Finance Act just to clarify on something that you've already mentioned. Thank you,
Mm.
Irene, for that. So, there's a question that has not been answered from Stanley Chepto. Maybe
Yeah.
you might have missed it.
Oh, the club.
No. What will happen if I have committed 2/3 of my payslip on the 1.5% on housing?
2/3 of your payslip.
Yes. And also
This.
the one for the taxes for club membership.
Okay. I will
Yeah.
start with the club membership. The club membership, what happens with the club membership, as I saying that it will be taxable as a benefit. So assuming that your salary is 100,000 and you are being paid for entrance club or 500,000, 700,000 as entry fees. So your employer will add 500 or 700,000, whatever the club interest fees is, to your salary and determine pay on the new amount. And you pay based on the tax band, the total amount you pay based on the graduated scale that is issued. But essentially what you're saying that, so if it exceeds more than 500,000, you will pay up to 30% and then 32.5%. And then if it exceeds more than 800,000, then you pay at 35%. So it is actually paid within the normal pay rates. Any contribution to a club, be it entrance fees or subscriptions, will be added to your salaries and benefits and be taxed accordingly within the pay rates. Yeah, the other issue is the 2/3 payslip charge. Peter, are you there? If you can respond to that.
Yes, thank you, Ronald. I think that question is in line with the regulations that the government had published some times back. And there was that conversation that an employee should not have deductions that exceed 2/3 of their income, meaning that, when you take loans, when you take all these deductions and savings, then at least that should remain. But I think with respect to the housing levy, whether you have committed up to that much, I don't think there's an exemption to such a person. They will still need to be deducted 1.5%. Perhaps now the other question is, how would that particular person be treated by the employer in terms of the other deductions? But this being a statutory deduction, it has to be deducted whether you have exceeded the 2/3 rule or not, because one is like a guideline in terms of what should be fair to employees, while the other one is a statutory requirement for payment.
Is there any other question, Aurelia, or we proceed?
No, I think we can answer like 3 more questions and then we can proceed. So let me just read them out. So there's one who's asking if the housing levy affects expatriates. Let me just. Yeah. So there's a question from just a minute. From Esther Kinyanjui. She's asking, should expatriates contribute to levy? There's also another from Roba Wario. Since most employers have already paid July salaries. Okay. Since most employers have already paid July salaries and remitted the income tax, how will this be handled? Maybe you can advise on that. Another from Kabuya. What happens if I am filing for people earning secondary income from our organization? Another one from Susan. In the example of the club subscription, is the additional 500,000 on club membership paid subject to housing levy? Maybe I can come again on that one. In the example of the club subscription, is the additional 500K on club membership paid subject to housing levy? And then maybe the last one before we proceed from Jennifer. If I have multiple employers, into brackets lecturing, does it apply to each employer or just my primary employer? I think you can proceed and answer this one then. Yeah. Thank you.
Thank you. I think I can answer something and then Peter can add on. The issue of non-residents, You know, this housing levy, it is being actually put on the mandate of the employer to deduct and remit the housing levy. So you see, normally when you're having expatriate and non-residents and they're earning employment income from Kenya, we normally say that they are subject to all the statutory obligations. So it is implied that even if you're having non-residents, you as an employer, you have a responsibility on your payroll to deduct from everybody housing levy as prescribed. So it therefore implied that even expatriates will be affected because all employment in Kenya, income in Kenya from Kenya is actually payable and all that. So they will also pay. And then there's somebody who has talked about the secondary employees and all that. You know, in Kenya, we have the primary and secondary employees. So, you know, for primary employees, you know, you normally deduct pay, but for secondary employees, you can always do, you always have those, you can do withholding tax, especially like for consultants and all that, you do withholding tax. So normally those are not employees. If they are consultants with the organization, you may fail to do the 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 housing levy if you are doing withholding tax. But again, for employees, the payroll, those who go through the payroll, you have to deduct 1.5% and all that. So they will not be subject to statutory obligations if they are secondary employees because it is based on primary income. Maybe Peter, you have something to add on that?
Yeah, so I think you put it very well. The intention of statutory deductions is primarily meant for primary employees, or when we look at the spirit of those regulations, it's supposed to be applicable to primary employees, because remember, the people that you're calling secondary employees are also earning primary income elsewhere, and it's possible that they're also being deducted such deductions in their primary place of employment. So, of course, subjecting the same to an additional deduction, then it might amount to a double deduction on their income. So, again, these are some of the things that needs also a lot of clarity, especially once the guidelines are published. It will now be very clear who are the people to be exempted or what sort of consideration needs to be also considered or to be put in place. So, but as we look at it at the moment, the objective is to impose these on primary employees. Now, with respect to July salaries, I think someone asked what happens because the July salaries had already been paid. And of course, the Court of Appeal gave the green light on 28th of July when some of the people had already processed their payrolls. And I think Ronald had mentioned initially that there is a need for employers to go back, look at their records again, and ensure that these taxes are deducted. Perhaps they might need to, bear the burden as employers, or deduct and effect the same in the subsequent payments, because some of these payments, the employees had already earned the net income. So there are those two options that the employers will need to consider. I don't know whether we have missed out on any question.
I don't think so. If you have, I think we'll be able to address it in our next session. So yeah, we can proceed to the other topic.
All right, that's okay.
And I saw somebody saying, Peter, or the issue of directors' income, whereby, most of the directors is they always deducted 30%. And, the essence, the reasoning behind deducting 30% from the directors is the assumption that they have primary income. And see, it is on this primary income that all the statutory obligations have been deducted, the NSF, NHIF, including housing levy. So it's assumed that if you have those directors who are paying 30% withholding on their secondary income, then you may not need to necessarily deduct additional housing levy because that will be a bit of increase. But again, you don't know because based on the KRA government, they might issue clarifications to demand tax on that. But as it stands, the assumption that they will not require to pay additional housing levy on that those emoluments. So we can proceed, Peter, and I don't know whether your presentation can be expanded.
I hope now it's okay.
It's expanded, but I don't know why it is not showing full screen.
Yeah, maybe you can put it in presenter mode.
Much better?
It's not. I think because of time you can proceed, but just make sure that you enlarge it because it's not showing nicely. You can just enlarge it. Yeah.
Okay, maybe. What about now?
Unfortunately not.
Okay,
Yeah.
I think let's just proceed because I know we might not be having so much time.
Yeah,
So,
just reduce it a bit. Reduce it a bit. Just return it the way it was so that we can see. Because some things are disappearing.
Okay.
Return it a bit, yeah. Yeah, there. You can proceed.
All right, so I think we can proceed with the income tax changes. And Ronald, I think, mentioned about qualifying intellectual property income, which I think he discussed at length, which is supposed to, position the country as a research hub so that developers who use our country to create softwares, to create intellectual property can get very favorable tax terms or preferential tax rates. With respect to withholding tax, there has been a very consistent sort of initiatives by the government in terms of reducing the time frame for remitting taxes. And I think we've seen that now they're saying withholding tax, which was supposed to be paid by the 20th of the following month following a transaction, now needs to be paid within 5 working days. And it's the same thing that has been applicable on the rent, the withholding tax for rent, also the VAT withholding tax, which you're going to see later. And of course, there are also sectors whose taxes are required to be paid within 24 hours. For instance, people who are in betting industry have been required to, make sure that they pay the excess duty deducted, or rather the withholding tax deducted from the winnings and remit that within 24 hours. So it's a trend that has been going on, and it appears that in the next couple of years or even months, we might get ourselves in a situation whereby most of the taxes are actually paid on real-time basis. And especially when you put into consideration the changes that are coming from Teams, the changes that are coming from these other platforms, it might be possible that the government will know how much taxes you need to pay, or rather the volume of your transaction on a daily basis. And who knows, they might say that now we need to start paying VAT or starting paying pay as you want on real-time basis. So this is very critical, and I think it's applicable to all institutions or all taxpayers, in the sense that when you deduct withholding tax within 5 working days, you need to have remitted that to the taxman. On digital content monetization, again, we mentioned that when there's some trends in the economy, when there is some changes in the economy, the government will always want to keep up and bring legislation that helps it to tap into those particular changes. And over the last couple of years, we've seen a big growth in this digital content industry. We have so many digital content creators in the country. I'm pretty sure you know them. The likes of Terence, the likes of Chris Kena, I think all of us know them. So the government has sort of decided now to impose taxes on payments made to such digital content creators at the rate of 5% and 15% for resident and non-residents respectively. So this is a way of saying, yes, this is a booming industry on its own, and there has been no ways of taxing it. But then due to the nature and the way that industry is developing, then that has necessitated the need to impose taxes on the same. And like a normal withholding tax that we've seen, the deducted taxes needs to be remitted to KRA within 5 working days. Again, also quite a bit of I would say tedious to taxpayers because things that we would do as end of month procedures will now need to be done almost on a weekly basis to adhere to the compliance requirements. Then in 2020, we saw introduction of withholding tax on sales promotion, marketing, and advertising fees, mostly paid to non-residents. That is through the Tax Amendment Act of 2020. But now through the Finance Act of 2023, the same regulation has now been imposed on residents. So when you pay advertising fees or marketing fees, either to the TV, to the radio stations, to the marketers that we have around, you need to deduct withholding tax at the rate of 5%, and of course observing the minimum threshold of 24,000. So again, this is also very disruptive because previously these are payments which were not subject to withholding tax, and now we need to adhere to it. So remember, again, this will also need to be remitted within 5 days upon the transaction. So when the deduction is made within 5 days, then it needs to be remitted. Let's look at some of the changes also on advance tax. And advance tax, as the name suggests, is a form of tax paid in advance, especially with respect to motor vehicles. So institutions that have commercial motor vehicles are required to adhere or to remit withholding tax. And we are seeing a huge increment in the rates for advance tax.
Peter, maybe your name is not moving. Peter, your screen is not moving. You can decide to put on off video a bit so that your screen can move. It's not moving.
Okay.
That's okay. We can see now.
Okay. So can we proceed?
Yeah.
Are we at advanced tax? Yeah.
I can see that. You can try to put off your video off so that we can make sure improve the quality of the presentation.
Okay. All right. That's okay. I think technology always fails when it matters most.
Yeah.
So I hope that is now clear.
That's okay.
All right. So thank you. So on advanced tax, as I was explaining, it's mostly applicable to institutions or taxpayers that have commercial vehicles. These are, pickups, trucks, and the like. And we are seeing a very significant increment in terms of the taxes relating to this. For instance, for commercial vehicles that are used for carrying luggage, the rate is moving from 1,500 per ton to around 2,500 per ton per vehicle. So it's sort of computed based on the tonnage, so which is an increment almost of around more than 50%, almost 70% increment in the rate. And then for cars that are passengers related, so we are seeing a rate increment from 60 shillings per passenger to about 100 shillings per passenger. So again, very significant increment on that, which are going to affect companies or taxpayers that own commercial vehicles or that have passenger vehicles. So as again, this advance tax is normally deductible at the end of the financial period. So you don't lose it out, but you're able to offset it against your income tax obligations at the end of the day. Let's look at some of the incentives. As we had mentioned before, it's not all lost in this Finance Act. There are a few things that are positive. And we have seen the government attempt to introduce a number of incentives that are meant to promote investments in the country. Maybe may not be so much applicable to pension sector, but it's also important to mention them quickly. For instance, manufacturer of human vaccines will now be taxed at the rate of that 10% as compared to the 30% applicable to everyone else. Then contractors that are working on a grant-funded project, or rather 100% grant-funded project, will also now be exempt from income taxes, of course, up to the extent that has been specified in that agreement. Then you're also seeing further incentives on special economic zones. So special economic zones are zones that have been gazetted by the government as sectors or as zones that the government is keen on encouraging investment in those particular areas. For instance, Tatu City is one of them. And within the special economic zones, you normally find that the tax rates are very low. For instance, the corporate tax rate is 10% for companies or institutions that are based or domiciled in special economic zones, and so many other tax advantages. You know, they're exempt from VAT. They're also exempt from import duties and the like. So this Finance Act is attempting to increase further, or rather to give further incentives to these enterprises or to the special economic zone enterprises by ensuring that you know, management fees, professional fees, and all form on nature of fees paid by them are exempted from income tax deduction, especially when paid to non-residents. So again, it's a measure meant to make as our special economic zones more attractive and ensure that we are bringing in investors, especially from other countries, to come and invest in our sectors or in our special economic zone sectors. Then we've also seen a number of deductions or allowances, capital allowances that have also been introduced. For instance, the 10% industrial building and dock deduction that is going to also come in handy for players in this sector. So they'll be able to deduct 10% of the investment every year until they recover it and offset that against their taxable income for the year. The same thing has also been introduced on hotel buildings. So if you as a pension scheme decide to put up a hotel building as an investment, then you're going to qualify for 100% investment deduction, which will now push that investment to almost you know, paying zero tax for a number of years until the investment is fully recovered. Then manufacturers are also given 100% investment deduction. Previously it used to be 50% and 25% subsequently, but now the Finance Act of 2023 has introduced 100% investment deduction on this. Then lastly, for non-resident companies, non-resident companies have always paid their taxes at a rate of that 7.5%, but then that tax rate has been reduced to 30%, which is now similar to the rest of the taxpayers. So also a good thing, because it also creates a level playing ground for these taxpayers, and they shouldn't feel disadvantaged. But remember, we said even as the rate is reduced, there's also an increment, there's an introduction of the repatriation, or rather the tax applicable on repatriated income at 15%. So again, someone might think this is the government trying to be mischievous in a way, because it's giving a reduction on one side, whereas on the other side, it's introducing a new tax. So whether it meets the intended objective of attracting investors is a matter that we want to wait and see. Now, let's look at tax procedures amendments. And tax procedures, just for clarity, are a set of
Peter,
rules.
again, Peter.
Yeah.
We also stuck, it's not moving. I don't know what's wrong.
I don't know, because
From your side, you're moving.
yes, from my side, I can see I'm really moving. At
Yeah, now it is gone to the tax procedure, but I don't know why it keeps on sticking there.
I think it's sort of a delay, maybe.
Okay.
Yeah, it could be a delay, but I hope you can please notify me when we are left behind, so that we all move in one accord. So on tax procedures, I was trying to explain what tax procedures relate to. And these are a set of rules that were published in 2015 through what we call the Tax Procedures Act of 2015. And they were meant to bring some sort of consistency in the way our tax legislation is interpreted and also implemented. For instance, when you pay your taxes late, the late penalties were contained or were streamlined in the Tax Procedures Act, and it defined what that penalty will be. If you get an assessment from KRA and you would wish to appeal it, again, the tax procedures give the modalities or give a guideline of how to go about that. So it's just a set of rules that help us implement or be able to interpret our laws in a more consistent manner. And the Finance Act has brought a number of changes to these tax procedures that we adopt as a country. One being on the tax decision, and we are seeing an sort of an increase or an expansion on the definition of the word tax decision, which they are now saying will now include a demand for late payment interest. And the meaning of this is essentially to say that if KRA demands late payment interest and you're not comfortable paying, then you have now an opportunity to actually appeal against that decision to the Tax Appeals Tribunal. So previously, it's something that you didn't have a way out, where you are being demanded for late payment interest and penalties. There was no reprieve whereby you're feeling that those penalties and interest are not legitimate. But now, with the expansion of the tax decision definition, then it sort of gives clarity that you can actually appeal that decision to the Tax Appeals Tribunal and even escalate it to either the High Court or the Court of Appeal. And Ronald, you can mention whether my presentation has since moved.
No, it's not. Let me project from you from my side.
Okay, kindly.
Okay.
I think I can stop sharing so that we are on the same page.
Yeah, Aurelia, I hope you can see from my side.
Yes, I can now see. I don't know where the problem was from Peter's side, but now it's working.
Yeah, it's okay. So Peter, I think we can move because we have a very short time. I think less than 10 minutes. We can summarize through.
We can summarize, yes. So that's okay. So I think I've explained the tax decision, which has been, the definition has been increased or rather expanded to include that demand for late payment interest. So on international tax agreements, again, the Finance Act has tried to adopt or recognize the various treaties and agreements that we signed with other countries and define them as part of our laws and procedures. So we will no longer be looking at those agreements as subsidiary legislation, but they will be part of our tax procedures. And this is what the Finance Act of 2023 has sought to do. If we can go to the next changes on electronic tax systems, I think there has been also a big discussion and debate on these tax systems, whereby we've discussed the TIMS matter at length. And all these changes, all those systems were brought in without being accompanied by a legal framework, in the sense that, taxpayer could actually have challenged imposition of TIMS, for instance. So through the Finance Act, the government is now sort of bringing in that legal framework to try and cover themselves against, people going to court saying, yes, you're implementing TIMS, but our law does not allow you to implement TIMS. So this is sort of just to bring a legal framework or a legal backing to the various systems that are being introduced. And this is on TIMS. It's also on the next one, which is the data management system. So they're all meant to give a legal backing or a legal framework to these systems that are being introduced by KRA, so that they cannot be challenged in a court of law, and that we can also read them, that they're in our tax procedures, and for sure they're also part of our legislation. So we can go to the next topic. Ronald, if you can scroll it for me.
Data management.
You can go to the next one. I think I've just explained the data management.
Tax amnesty.
Yes, so let's look at the tax amnesty, which is also a very critical change and also a silver lining that is being left out in the huge debates that we're having on the Finance Act. So we have an introduction of a tax amnesty effective or rather for taxes or penalties that were due up to that 1st December. And what this tax amnesty is saying that if you had paid your principal taxes for that period up to that 1st December 2022, but you had not gotten a waiver, or you had not even applied for a waiver of the penalties and interest, or even paid the penalty and interest that had been accrued, then you're going to get a waiver or a blanket waiver on all those penalties and interest, meaning that you will not be demanded taxes for that period. So this is also a very good thing that has been introduced through this Finance Act, and we are looking at it as more of an extension to the voluntary tax disclosure program that has been running since the year 2021, whereby people are told to come out, declare their sins in terms of tax unremitted, and get a waiver of penalties and interest. So this amnesty is an extension to that, and it's only applicable up to that 1st December 2022. And of course, if you have not paid all your principal taxes as at that 1st December 2022, all is also not lost. You have an opportunity to do so by 30th of June 2024. And if you do that, then you can still get a reprieve. At the same breath, as we get to this waiver for penalties and interest, we are seeing that the KRA's powers to grant waiver of penalties and interest now going forward has since been reduced, or rather the powers have been sort of removed. So we will no longer be able to apply for waiver of penalties and interest from KRA, because KRA will not have the mandate to do so. And even Treasury, which has also been criticized for arbitrarily giving waivers to friends and companies that are related to those people in power, those powers to give waivers have been removed. And of course, it's going to be very difficult if you accrue penalties or you incur penalties going forward, because it means that there will be no chance for you. You still need to pay the principal taxes as well as remit the penalties and interest that accrue. On ADR, ADR is alternative dispute resolution, which has also been a very instrumental framework for resolving tax disputes out of court. So normally we've been getting 90 days to resolve disputes out of court, but then through the Finance Act, this timeline has been extended to about 120 days, which is about 4 months, to try and encourage most people to use the framework to resolve the tax disputes. So on agency notices, again, we've seen a lot of KRA letters, being issued to banks, being issued to suppliers, sometimes customers, where you have some unpaid taxes. So the Finance Act is intending to expand the spectrum of circumstances that can lead to KRA issuing the agency notice. So initially, it only used to apply where, or rather as a last resort, where KRA has really tried to demand taxes from you, and you've ignored their communications, you've ignored all their measures. So that is the time they used to issue agency notices. But now that spectrum has since been extended to instances whereby you have defaulted on an installment, you have not objected to a tax assessment on time, you have also not appealed maybe the prescribed timelines or in the manner. So it's sort of giving KRA the chance to issue agency notices almost at any instance whereby someone has not paid certain taxes. So not a very good thing, because you certainly don't want to see your bank sending you letters that they have been instructed to remit taxes on your behalf, or even your customers telling you, hey, we've received this KRA, we are not going to pay you, we are going to pay KRA instead. So it's not a very good thing, and it's creating sort of a conflict or a bad blood between KRA and taxpayers, because it means that even in instances whereby maybe the delay has been occasioned by normal circumstances, KRA will still send those agency notices to your banks and to your various stakeholders. On rental income tax, I think this one we had already discussed, and the Tax Procedures Act has since been revised to empower KRA or the Commissioner of Domestic Taxes to appoint a rental income agent, the people who collect rent on behalf of others, and tell them that they need now to remit taxes on behalf of their clientele. So again, we think this will enhance tax compliance amongst landlords, but also creating a lot of burden to these agents, because they will now be held responsible for remitting taxes on behalf of their clients. On the timelines for withholding taxes, I think this one we had already discussed. We are seeing that consistent move to reduce the timelines for payment of taxes. It's another way of the government saying, hey, we want our taxes now. We don't want it in 10 days or in 15 days or in 20 days. As soon as you're able to pay, the better. And that's why we are saying initially that we might go to an era whereby taxes are paid almost on real-time basis, especially with the coming in of all these particular systems. So, of course, there are people who are exempted, especially people who have invested at least 3 billion have been exempted from those VAT withholding, and also, of course, the timelines. So we are seeing the big guys have been given more incentives, whilst the small and or rather the normal taxpayers are being sort of punished, or they're being given a lot of obligations to comply with. Now, we want to look at VAT changes very quickly because we wouldn't want to get to 1 p.m. So VAT has also been one of the things that are heavily contested in this Finance Act, especially the issue of petroleum products or fuel, which has been subject to VAT at the rate of 8% previously, but now there's a proposal to increase that to 16%. So perhaps almost immediately we've seen the way fuel price has really gone up due to that, and it was a huge conversation given all the global challenges, the conflict in Ukraine, which has also exacerbated the problem we have with the fuel cost. So it was a bit unreasonable for KRA, or rather for the government, to increase taxes on such a product when we are having all these other challenges or all these disruptions on the supply chain, including the exchange rates of our currencies. So it's also not a very good thing, and it's one of the things that have been contested in court in terms of this Finance Act. On a positive note, the LPG, the rate has been reduced from 8% to 0%. So gas will become cheaper, at the same time, fuel becoming more expensive. So that is on the petroleum products. On input VAT deduction, there is now an additional requirement whereby when you buy commodities, or when you get an invoice from your suppliers, you have to ensure that that supplier also remits that VAT that you've paid to them. Otherwise, you'll not be able to deduct, or you'll not be able to claim that input VAT, which is also a bit unreasonable when you think about it, because most of the time, once you get an invoice from your supplier, your power ends there. You're not able to control what they do with the invoice, whether they decide to remit their taxes or not. And for the government to put a condition that you must ensure that the supplier remits the tax before you can claim it is a bit, unreasonable, and also giving a mandate to taxpayers that exceeds their abilities. On exported services, we've also seen a good change on that. We had seen government saying that when you offer your services outside the country, or when you export or do something for people outside the country, that you still need to charge the VAT. And the norm in the, especially even given the OECD guidelines, most exported commodities are normally zero rated. So it was a bit unreasonable to provide for VAT on them. But then through the Finance Act, that has since been changed from 16% to around 0%. So on insurance compensation, again, very contentious issue here. And the Finance Act is saying when you're compensated by your insurance companies for loss or damage on vertical items, then that particular transaction will be deemed to be a vertical transaction, and VAT will be payable on it. So again, there's also questions to do with constitutionality of some of these changes, given that an insurance compensation is supposed to take you back to your initial position before maybe the loss or the damage took place. So for you to be told to pay VAT on that, then it's really unreasonable, and there's no value really added, because remember, VAT is a value added tax. So when you're being compensated by insurer, or rather insurer, then you cannot be said to have created a value, because you're simply being indemnified to your previous position. On record keeping, also straightforward. Taxpayers can now keep records anywhere in the world. The records don't need to be here. So government is sort of employing or rather adopting the digitization and saying that you can keep your records digitally or even physically wherever you want in the world. Then, of course, for digital service providers, again, their threshold has been removed. Remember, we normally say you only register for VAT when you have supplies above 5 million. But now for these non-residents who are supplying digital services, that threshold of 5 million does not apply to them. They need to register whether they have met it or not. As we can proceed to, maybe you can go to the next one, Ronald.
So I believe, Peter, hello?
Yes.
You can conclude that the low carbon emissions, because I believe that most of the other issues of excess duty might not really impact members here.
Yeah.
So
yeah, yes,
yeah.
for sure. So excess duty will not be applicable to pensions. And of course, there is really no need to discuss that, especially given the time constraints. So on low carbon emissions, so I mean, the world has been going through a crisis, an environment crisis, and there's a huge encouragement, or countries are really trying to ask themselves, how can they give incentives to people, to taxpayers, to reduce the carbon emissions? And we have also not been left behind. And for VAT, we are saying that through the Finance Act, supply of electric bicycles, supply of solar and other batteries, supply of these electric buses, and we've seen quite a number of them. Those transactions will now be zero rated for VAT purposes. So people who are dealing in these particular items or supply of these particular commodities will not need to pay VAT in a bid to encourage most people to use electric vehicles, to use electric buses and the like, in order to reduce carbon emissions and perhaps as so doing save our world. So I want to conclude with that and of course invite my colleagues Valeria to take questions. We can do maybe a couple of questions before we conclude the session. So thank you so much for listening to me, and I look forward to answering your questions. Thank you.
Yeah. So thank you, Peter, for taking us through. And I believe, Aurelia, now it's back to you. It's 1 p.m. I think from our part, we have concluded there. We can get a few questions if members are willing to take to give us some few minutes just to address the questions. But normally webinars are not necessarily meant to give you full knowledge. We are going to share with you the PowerPoint. It's to create awareness. Then you'll be able now to go deeper and deeper and deeper. Otherwise, if we are supposed to go through each and everything and explain to you the process of even filing these returns and some of the exceptions and all that, it will take us a whole day. So mostly for you who is a tax expert, it's easy actually to take this knowledge and apply it. For you, if you are not an expert, at least you've been made aware in terms of what has changed, what has not changed, and how this impacts your organization. You can always get further clarifications from us and get an expert advice. And then we proceed. So I think really we can take some few questions and then we close these sessions. Yeah.
All right. Thank you so much, Peter Mwanja, for that well-put presentation, as well as Ronald. So there was just one question in the chat box that has not been answered. It was from Joe. He was asking, is it lawful to backdate housing levy from July in August?
That's a good question, but there's some good politics also. Yeah, so the thing is, it will be good to proceed for henceforth, as I said earlier, that we start from 1st of August, but the government is not willing to back down. It's saying, hey, look, we already, in fact, you can see sometimes the government wants to have its way. Fuel levy was actually implemented, the 8% VAT on fuel was implemented against the law, because the law had not become into place because of the court suspension, but they had their way. So we hope that they will also not have their way on backdating the VAT, the housing levy from 1st of July. We hope that it will be futuristic rather than backdating it to 1st of July as a sign of goodwill and also courtesy also, and also respect of the rule of law. I agree with you, but again, it is government.
All right, thank you, Ronald, for addressing that. There's also another one from Beth Gitao. She says she missed the response on Anthony Kimoi. Anthony Kimoi had previously asked a question on, let me just read it out for you again. The secondary income we are referring to is, say, like a director paid a monthly allowance or an overtime job pay. So the question is how to tax this. Remember the question?
Yeah, I understand. I remember that question because we said that because normally for the basic deductions, we are assuming that the housing levy will be deducted at first of 1.5%. The loophole is that the government has not put a capitation on the housing levy, and without that capitation, there is a risk that in future they will want to extend to secondary income and all that, so that they have to have a maximum amount. So we hope that will not succeed. But then now the understanding that the housing levy is a levy and will be levied on the primary income and not on secondary income. So that is the understanding for now. So, but we hope that even the future guidelines will stick to that, and probably because, as I say, there's still a very gray area because they have not put a capitation. Because if you are earning a salary of 1 million shillings, then your housing levy deduction is 30,000, which is quite significant for most of people. If you're earning 2 million, then you're being said you are supposed to pay housing levy of almost 60,000 shillings, which would be very devastating. So we hope that in the subsequent rules and regulations, and as government deliberates on it, it will put a capitation in terms of the maximum value, the way it had done in the finance bill. At the same time, limit that housing levy to only the primary income. But as now, we can just assume housing levy, because it's a levy like any other levies like NHIF and all that, will apply to the primary income.
All right, I think that's in order.
But again, Aurelia,
yes,
I will put a caveat. This is not a tax advisory, it's just information. For you to get an official tax advisor, we take no responsibility.
That's important that you've said that.
That cannot be, that can be disappointing, but yeah, but
you're sharing the knowledge that you know, so
yes.
Okay. I think you were not so clear on Robawario's question.
Yeah.
Remember, he asked about is it lawful to backdate the housing levy from July in August?
Yeah.
So I think he needs more clarity on that. Maybe you can address that as well.
No, I answered. I said that is what the finance bill is meant. Because one, if you talk about illegality, there is so much illegality that is being committed by the government. 8% on VAT is an illegality. But you see, the government has had its way. Yes, the judiciary, the appeal courts passed the finance bill just on 29th July. It is expected that the housing levy and the finance act will be applicable subsequently, probably from 1st of July, August. They will revise the amendments. But because it's government, there is a risk they might be zealous enough to try to say, let's begin it from 1st of July. And more probably we have nothing to do. But I believe that there's still some court applications that are being made. Somebody will apply to challenge the commencement period of this finance act from the 1st of August. At the same time, also challenge some of those things like housing levy and all that, so that they are actually either removed or more clarity is given on this. So yes, there is an illegality, but there is a political process. Yeah.
At 30% or 35%. Please talk about how to tax the secondary income itself.
Yeah, we say that currently, if the secondary income exceeds more than, I understand what he's saying. I understand. Initially, we've been saying that the secondary income is taxed at 30%. That has been the highest capitation for the tax. So most probably now the KRA will be demanding 35% on secondary income. But then now that is the assumption that it is exceeding 500,000. But you remember that even when secondary income was being charged at 30%, it was the assumption that somebody who is earning secondary income is assumed to be getting more than 38,000 shillings, which was the minimum for secondary income. So you see, now I believe that the charging now will change to 38, 35%. Of course, then after that person who is earning a secondary income, after they do their individual tax computation, they might have a tax credit and a claim for a tax refund because of overpayment when they apply the graduated scale or the scale rate appropriately. They will have a tax refund if 35% has been deducted from their secondary income. So the application of this will be applied now. 35% will be applicable now on secondary income. And if I'm earning a period, like for instance, let's say 300,000 and then 100,000 is secondary income, which now I pay 30%, which is 30,000. There is then a possibility that I will fall into tax credit because I've been disadvantaged because of being above the below the scale rate and all that, and they're yet being taxed at a higher tax band. So I agree, I understand that question, and I think that is the way to go about it.
So he was asking, is it true that the housing levy is only for salaried Kenyans earning 150,000 and below? That only Kenyans with monthly incomes of 150,000 and below are eligible for affordable housing? Is it clear? I think.
Yeah, I can understand. I can understand what he's saying.
All right.
In terms of legibility, again, we are saying, you see, the information memorandum that the government, the treasury, and remember the government was providing for the housing levy, those to qualify, those will be refunded houses and all that. It has been overtaken by events because when they changed from 3% and to 1.5%, they are yet to give a more guidelines who qualifies for the house, because initially it was like a saving housing levy. Now with the 1.5%, they are saying it's a levy which is not refundable to you, and you're not even the government is not under obligation to give you a house. So it therefore follows that then now they even need to tell us we'll be getting the house, because they're saying that it's for low housing people, it's to support low cost or low income earning individuals. So again, we are waiting to see whether they will amend that criteria for allocation of the houses built. Again, you realize that they were saying that even when you get that house, you get it as a mortgage, not as a free house and all that. And they have not said who qualifies. As it is now, we have such kind of implementation under the Kenya Mortgage Refinance Company, whereby they are giving people for those people who are earning less than around a salary of 150,000 and below, they're giving them a mortgage at 9.5%. So I believe that this housing levy is just to enhance that, but probably pick those people with a lower income below 150,000 shillings. But again, we expect that the government will give much clarity, especially in the work of the revisions on those rates, to collaborate with those new revisions and contributions.
All right. I think then that's all for the questions. I hope we've not limited any person who has a pressing question. Yeah. So I'd like to just go ahead and finalize this. Ronald, are you still with us? Yeah, I think he might be having some technical issues. But I'd like to take this opportunity to thank the Ronald's team, that is CS Ronald himself and Peter, for taking us through the Financial Act. I think this act, we've heard so much about it, but we've never really had a chance to delve deeper on what it entails. So I hope they have covered all the topics and the questions that we had in regards to it, especially on the housing levy. So we like to also appreciate all of you for joining us, especially for those who joined from the beginning up to now. We have eaten a little into your lunch hour, but I'm sure this knowledge had to be shared somehow. So we really appreciate all of you. So we'll be sharing all the slides after this presentation. So make sure if you are not able to register, you can just contact us directly using trainings@finettrust.com, and then we'll be able to sort you out on the slides. Yeah. So before we wrap it up, I'd like to also just present our next program that we have on board. It's on fund investments, finance, and strategy board committees workshop. It's very timely, especially now that we've spoken on all issues finance. So this will really work well for trustees who will be interested. So just you can look at what has been shared. That's the flyer of the training that is upcoming. So it will be happening at English Point Marina, and the target audience for this particular workshop is the board of trustees, board of directors, CEOs, trust secretaries, employee benefits consultants, pension scheme administrators, and other service providers. So if you are keen about this program, we will be sharing the brochure together with the training slides. You can engage with it, and then we will discuss more on nominations or how to attend it. So that is all from Finnet. We really appreciate your time. For people who joined after Godwin's introduction, just to remind you that we do corporate trainings, and we are really happy to engage if you have any questions regarding the trainings. Yes, so just to clarify, maybe I might have missed that. The dates for these fund investments is from 22nd to 25th of August. So I'm sure we'll be having very interesting conversations then. Please engage us, and let's see how we can work together to improve this pension industry. So I don't know if Godwin is still with us. Maybe you'd want to say a word before we close up.
Thank you, Aurelia, and thank you everyone for making time to be part of this webinar. We believe it's been insightful and also very engaging, going by the conversations that have happened. It's a Friday today. We want to wish everyone a nice weekend and stay safe as we continue building the nation. We appreciate you so much from Finnet, and keep on the lookout for any other webinars or trainings that may be out there that will be releasing as we move throughout the year. Thank you very much and have a good afternoon.
All right. Thank you, everyone. Have a lovely Friday. Bye-bye.